Good evening, everyone. Thank you for joining us today, and a very warm welcome to our clients, friends, and members of Aeka fraternity. I am Ankit Toshniwal, a director at Aeka Advisor, and with me I have Chetan, Nadig.
Hi everyone, good evening. Hope all of them are doing well.
Yeah. So we'll just wait for a couple of minutes for other people to join, and then maybe we can just get started at by next 2 minutes. Thank you once again for our friends and network family to join this session. So today marks the beginning of the masterclass series that we will be conducting over next 1.5 months through multiple interactive session, which will be focused on understanding and navigating the newly enacted Income Tax Act 2025. So over the last 6 decades, there has been a lot of amendments, circulars, notifications, judicial interpretation that has been layered over the Income Tax Act 1961. While undoubtedly this act has served the India economy for over last 6 decades, but it has become really complex, right? Both in terms of a language and as well as in terms of an administration. Hence, the Income Tax Act 2025 act as a reset. So, if you see, Income Tax Act 225 is not merely a round of amendments. This was a conscious effort that the government has taken to redraft the rules, simplify the language, rationalize the provision, and align that with the modern and technological landscape from a tax perspective. Hence, it becomes really important to analyze what has changed, how that has changed, and how those changes has impacted for a professionals, a client, investors like us in making decision with respect to certain tax matters. That is where we have started this master class on Income Tax Act 2025, where we would be decoding the Income Tax Act 2025. We would be navigating what changes has been done when compared to IT Act 1961. We would be discussing about the transition and implementation aspects, and most importantly, focus on practical implications and interpretational themes, right, which are likely to shape our positions going forward. So before we begin, we have just put out the schedule, which we would be conducting over next 1.5 months, where we will be discussing about various aspects of this Income Tax Act 2025. So moving to next topic. So when we talk about Income Tax Act 2025, let us understand how the income tax provision has evolved in India over a period of time. The first formal income tax was introduced in the year 1886, right? And the primary reason this was introduced for raising revenue to meet the internal rebellion at that point of time. And if you see in 1880 eras, the focus of income tax was not driven out of any economic reforms or any equity consideration. That was a mere mode to collect revenue to meet the administrative expenditure and to expand the colonial administration of the British era. The next milestone when we talk about income tax framework in India has come in 1918, right? Wherein because of the World War I, the pressure was felt to revisit the Income Tax Act 1886, right? Bring in various source of income to the tax net. And also at this point of time, the formal heads of income was introduced within this Act 1918. However, in 1922, right, the 1918 Act was overhauled, mainly because of the complexity or mainly because of the ambiguity that was present in 1918 Act. And no doubtedly, the 1922 Act has served at that point of time in India economy for over 4 decades. It was the 1922 Act where the concept, what we have been hearing, what we have been implementing in practical life, the concept of assessment year, previous year, was introduced in the year 1922 itself. It was in the 1922 Act where the assessment structure was discussed, where the appellate hierarchy was introduced, right? However, like I said, this Act, 1922 Act, has served the India economy for over 4 decades. There has been a plethora of amendments that has been done either in the Act itself or through the Amendment Act of 1939, which made the law very fragmented and difficult to navigate. Hence, 1961 Act was required at that point of time. And moreover, post-independence, the Act was necessary to incorporate the constitutional reforms, set up the developmental priorities, and also bring in the effect of independent India, moving out of the colonial administration. That was the motto of introduction of 1961 Act. This next slide. So, I mean, when we talk about 1961 Act and how that has translated to 2025 Act, let's understand what are the key features of 1961 Act first. The 1961 Act provided a clear and scientific classification of various sets of income, what we have today, right? Whether it's income from house property, salary, capital gains, PGBP, or income from other sources, right? And why this was critical? Because every stream of income has a different way to compute taxes, right? Hence, it became important to have a clear income classification, which was introduced in 1961 Act itself. Moreover, when comparing 1922 and 1961 Act, the 1961 Act brought the concept of structured sections, schedules, definitions, which became important to understand and navigate the tax laws when compared to 1922 Act, right? And undoubtedly, the Income Tax Act 1961 has served the India economy for over 6 decades, right? There has been globalization, liberalization, digitalization, various FDI reforms. There has been capital market deepening. All those things has been factored and has been supported by the 1961 Act, right? Lot of important sections around that, whether it's a significant economic presence, whether it's equalization levy, whether the provisions of MAT, whether providing the concessional taxation regime like 115 BAB, 115 BAA, all those considering the economic factors was introduced in the 1961 Act itself, right? Moreover, if you talk about, well, there were certain flexibilities, incentives that were being provided to the assessees. At the same point of time, when we talk about the anti-abuse provisions like GAR, place of effective management, BEPS, permanent establishment concept, indirect transfer concept, where the, I would say, the child of the Income Tax Act 1961. However, 1961 Act, 6 decades, has brought a lot of amendments. It can be thousands of amendments. There were a lot of provisos being added over top of another provisos. Over the years, explanations being added to clarify other explanations or other provisos, which at certain point of time became difficult for an individuals to navigate, understand, uh, and decipher the law. And that is the reason lot of things has gone into litigation before the judicial forum. Moreover, um, considering the technological and modern environment what we are living in, there are few aspects which has been outdated under the 1961 Act, and there was a requirement to revamp that, right? Hence, the revamp was necessary. The movement from 1961 Act to a new tax code was very necessary at that point of time. And it is not that the government has thought about in making or revamping 1961 Act in this year itself, right? The first thought of revamping the Act itself was taken in the year 2009 when a direct tax code bill was introduced before the parliament, right? Over a period of time, that direct tax code bill was presented before the parliamentary standing committee. Further, an expert committee was constituted over a period to revamp the direct tax code bill itself, right? And the whole motto of DTC at that point of time was to simplify the various acts in one place, simplify the language, rationalize the provision. However, because of the policy shift or the government change, DTC never saw light of the day. Having said that, the key important provisions what DTC had brought into, whether it's GAR, whether it's poem, whether it's the advanced pricing agreement, the concept of APA, whether it's a requirement of having TRC or MAT, was later introduced by Income Tax Act in Income Tax Act 1961 through various amendments. Having said that, the department never left behind the thought to revamp 1961 Act, and the thought became a reality in 2025 when the income tax bill was presented in the Lok Sabha, and which further got approved by the Rajya Sabha and finally received a presidential assent in the month of August 2021. This time, it became the reality that yes, we as a generational youth are getting a new Income Tax Act 2025, which is effective from coming April 2026 onwards. Now, what are the core principles on which Income Tax Act 2025 has been built upon? Right. So there are three core principles upon which this Income Tax Act 2021 has been built. First one is the simplest and the structural textual presentation, which would have provided more clarity and coherence, right? There is no modification of any tax policy, no modification of any tax rates that Income Tax Act 2025 has brought into its umbrella, right? And this is more for the clarity and continuity and certainty what the SSC would have got by transitioning into 2025 Act. It can be always said that Income Tax Act 2025 is nothing but a wine in a new bottle, right? What changes has been brought into Income Tax Act 2025 is simplifying the languages, removing the concept of provisos, eliminating the obsolete provisions, right? And rationalizing the sections in form of tables or formulas to that extent, right? So that was the motto of bringing in 2025 Act, right? And so if you see what has happened in 2025 Act when compared to 1961 Act, right? The wordings has approximately reduced by half of the times, and so there's a chapter and the section number, right? And the way the tables and formulas has been seeded into Income Tax Act 2025, that is one of the important aspect to navigate to understand those sections, right? If you see that the TDS provisions that has been clubbed into one section itself by way of a table and formula, which becomes easy to understand and navigate, right? Moreover, even the exemption sections have been brought at one place itself, right? Whether it's a section 10 exemptions or whether it's a section 47 exemptions has been brought in the form of a table, right? Which provides certain clarity for a reader to understand, right? Um, and there are a few other key definitions, which anyways we will discuss in the subsequent slides, which becomes really important to align ourselves with today's modern and technological environment. So those were the reason why Income Tax Act 2025 was introduced. And seeing the chapter number, while the chapter number has fallen from 47 to 23, right? But the chapter concept has largely remained the same, right? Whether it's a basis of charge or whether it's a income forming part of total income, the essence of the 1961 Act has been carried by 2025 Act with the changes in the language and simplification. So, having said that, we would like now to move to next topic, which would be taken over by Chetan Nadig.
Sure. Thanks, Ankit. Thanks for this. As Ankit made the statement, right? So the way we look at the new income taxes, the old wine in a new bottle, in a newly designed bottle, right? So if you were to break into the nitty-gritties of what changes have happened, maybe in this particular session, we'll try to identify how definitions have changed. Have there been a real impact on the definitions? And then we'll talk about charging section, as well as one important aspect would be how does my transition work from old to new law? I think broadly that's what we'll be covering in nitty-gritties in this particular session. Maybe I'd like to start with saying that previously we were so used to calling previous year assessment year as a concept, which essentially has been done away with the new act, where the concept of tax year has been introduced, where it's more aligned to a lot of other jurisdictional income tax act use the word tax year. Maybe that could be the reason why there is a change in tax year. Moving on, one major amendment with respect to the definition is, which we generally work on, is on demerger. As a concept, previously, demerger was considered tax neutral, where through the General Clause Act, we always used to assume that 390 to 394 read with the new Companies Act, section 230 to 233 was interpreted, and for both demergers under the NCLT route as well as the fast track regional director route was assumed that it is tax neutral. However, with the video is not happening because I'm talking in your system. Yeah. Sorry, just taking if my just a minute. Sorry, I think there's some technical issues. Just give us a couple of seconds. We just. Yes, perfect. I think we were speaking on the dissection of section, the fast track merger as well as the NCLT demerger as well as the regional director demerger, where essentially we used to assume that it's a tax neutral position. However, with the new Income Tax Act being in place, it only covers section 232, 232, which is the NCLT route of merger. However, the fast track demerger has been kind of let away from the tax neutrality. Where if we read the General Clause Act, there has been a lot of views in the market where a lot of legal counsels have taken a view that even in the past as well as the new act, this could be a litigative view, as well as people are comfortable to say that uh, considering the machinery of the provision is for demerger, whether it's approved by an NCLT or a regional director, the tax neutrality should not really get any other color. But however, this will be a matter of debate, and maybe over next few years, this will be essentially time and tested with judicial precedents and will be time tested. Moving on, new law calls for the new market, right? In terms of how does electronic storage or other things work. So previously, the books of accounts were generally during the time when 1961 was enacted, where people used to have books where physical books were maintained. Then it got transitioned to say an electronic mode, etc. In the current fact pattern of being in the cloud era, etc., where the Income Tax Act 2025 clearly explains that now books of accounts which are maintained on a cloud storage, say for example, Zoho books, etc., that also will come under the purview of books of accounts. Apart from this, per se, there is no major changes in the definition of the law. Most of the language remains the same. However, with some simplification in terms of some explanations given, which are more easier to understand. Apart from that, there are no major changes from a definition standpoint. So moving on, just trying to give some references in terms of what important sections, the way it was in the previous act versus the way it's in the current act, right? So I would like to call it as 1961 Act and 2025 Act. Broadly, I think till section number 7, the alignment remains the same. But however, the other heads of income, etc., have seen a rejig, where I'm sure the reference of our colloquial language of, say, the typical 56 to 10 is no longer 56 to 10, but we'll have to read it as 92, right? I think that's where all of us will have to start chasing or looking for a reference of new section. Maybe this that will take time, but however, it's a transition which all of us would love to be part of, right? Maybe next, let's just jump into the mother of all sections, right? See, from a definition of income, we'll see whether it's a revenue receipt, capital receipt. And then we'll come to the deeming fiction of the provision, where the charging section essentially is 459, is a trinity in the Income Tax Act, where Section 4 gives us the charge, Section 5 defines the scope of the boundaries, Section 9 kind of gives us the extended barrier and the deeming fictions, where essentially the taxation rights are extended beyond the limits of what is there locally, right? So if we were to look at Section 4 specifically, if we were to delve into it, it's an entry gate for taxation, the way taxation can work. So previously, in 1961, there was concept of assessment year versus previous year, which now has been made to match with tax year. And then Section 5 and Section 9, as this has a lot of evolution, which I'll be covering in the ongoing slides. So if we were to compare Section 4 of 1961 versus 2025 Act, as I told, repeating, the concept of previous year assessment year has now been made as tax year. And there's no reference to previous year or assessment year. So previously, the reference in 1961 Act was only towards the income tax deducted at source or advance tax. However, now tax collected source also have been brought into the ambit of Section 4, where there's no ambiguity in terms of interpretational issues, etc. And another passing remark here is if we see the definition as well, or if we see the actual wording of the law, there's another phrase which is added, any additional income tax by what name called, right? Say until the budget, people would have been thinking what it is, but with the new amendments in the budget where there is additional tax which is levied on the buyback, where it's a different ball game altogether, right? That's where I think the definition of or the phrase of additional income tax may be relevant, and that will have its multifolds of impact from a charge standpoint. So moving on from a Section 9 standpoint, previously there was the concept of look through, where with a lot of amendments, the same got changed where a lot of explanations were added, where currently Section 9 in 1961 Act had a small section with, say, multiple explanation running down to pages, right? That has been now clubbed into one section where all the explanation previously has been made into an act, where it's clear to understand and there are no interpretational issues which wording gaps, etc., is not really put there, right? So one critical change what we notice in Section 9 of the previous act to 2025 act is previously the word reasonably attributable was only provided for business connection. However, the same wording was not used for SCP, where the word was used as attributable. Attributable in a general parlance would have a limited focus or a limited understanding, right? However, both of them have been now clubbed together, SCP as well as business connection, both of them aligned together, where the word reasonably attributes is being added to give a wider definition to say that everything under the sun will come under the ambit is the way to look at it. Moving on, let's talk about the evolution of how the charging section has really changed, right? Particularly with respect to section number 9, where in 1961, the when Act was enacted, 1976, there was a deeming provision which was introduced where interest, royalty, FTS, which would accrue or arise in India, was got into the ambit of taxation. From there, we moved on to the dot-com era, where explanation on business connection through dependent agent as a concept was introduced in 2003. Moving on, there was Vodafone judgment, which was a landmark judgment for all of us, where it was clearly laid down by Supreme Court that Indian law does not give the right to look through. Its form over substance was the key which was given as part of the Supreme Court judgment. However, the government post that judgment did undertook a retrospective amendment where the provisions of indirect transfer effectively was introduced and look-through provisions was inserted with a retrospective effect, where clearly the principles laid down by Supreme Court was effectively turned on. Then fast forward 2015, there were a lot of confusion which was created by the explanations added, where they clarified in terms of saying that what are the definitions in terms of what is substantial value for an indirect transfer, where the law became quite clear in terms of saying that how does the provisions of indirect transfer work? More than 51% should be held. Then they introduced the small shareholder exemption. Then the substantial value, the way it should be computed was added. Then the aspects of saying that how do you treat the substantial value if there is some change, those clarifications were added in 2015. With the change of government, with a lot of global outrage, as well as a lot of litigation in terms of arbitration councils, feedback, as well as judgment, I think finally the government took a step to say that whatever was the retrospective amendment undertaken in 2012, that is no longer applicable, which was done away with. And any provisions post 2012 was only applicable from an indirect transfer standpoint, which was a big relief because the point was you are widening the definition in such a big extent where you are effectively putting a 40-year-old history and bringing back to that into live matter, right? I think that was a good move from the government where this particular explanation or particular thing was introduced. Moving on, in 2025 Act, all of the explanations have been made into an act where they've also widened the ambit where the word, so previously accrue arising directly or indirectly through capital asset was the wording in section 9, where now they've introduced or from as well as being introduced, where it kind of broadens the definition, where it is very clear in bold saying that Indian taxation now works substance over form. Substance is something very critical. Also, I would like to give a reference to the recent Tiger Global judgment, where I would say there are two landmark judgments which has faced the charging section. One, which I spoke about, Vodafone ruling. The second is the Tiger Global ruling, where clearly it demonstrates that only having TRC doesn't really matter. Substance is something which is very critical. And every leg of a transaction, maintaining substance or ensuring it is the documents, etc., are maintained properly, something is is the go-to motto of the government, and it becomes very critical for all the businesses, for all of them, to ensure that the substance or paperwork around that is very watertight, and it cannot work in the same way it used to work previously. Maybe moving on. So with the basics of understanding of what's changed with respect to the charging provisions, right? Maybe I would like to just take the quote of Sri Krishna, who says in Bhagavad Gita, saying that change is the only constant. Where we appreciate, yes, change is the only constant, but what changes? How do we change it? Because one initial response for any new act which is being enacted is what stays, what goes away. That's a very important concept for each one of us to dwell on to say that whether from 1st April 2026, does all the old act related matters extinguish automatically, or do we still have time, or do we have to consciously read both of them together? So that's where the section number 536 comes into play, where clearly it demonstrates that how does the provisions work from a transition standpoint. This particularly from a taxpayer standpoint, what could be important is what about the assessments which are ongoing? What about losses? There could be so many credits. There could be so many assessments which could be pending, or there could be so many cases which are pending in Supreme Court, High Court, or any other judicial forums. As well as from a revenue authority standpoint, it's whenever there is a change in law, the act has to be very watertight in terms of what stays and what doesn't stay, and you don't want to keep any loopholes pending so that people try to take benefit out of it, right? Also, from a compliance and administration standpoint, it's a very important aspect for not alone the tax professionals or the clients. It's a important thing for the tax administrators as well, where department as well has to be be very focused in terms of how does the transition work. I think with 536 being introduced, there has been a clear demarcation in terms of each subsection clearly talks about each line of item, which is very critical from a transition standpoint. So here, what does 536 really cover about? How do we preserve the carry forward of losses, TDS credits, ongoing assessments? There could be so many past notifications which could have changed so many interpretational challenges, right? All of them, whether that will save, not save, or what is there, what is not there, is broadly what we'll be covering in the ensuing slides. So if we were to compare the transitionary provisions from 1961 Act to 2025 Act, broadly, the saving provisions were narrower in the 1961 Act. 2025 Act, it clearly demarcates for each section. People have really thought through in terms of the committee, which have clearly laid down the provisions line by line to understand these are the particular sections which needs attention. That's where the clarity has been brought through. One important aspect which was missed or rather overlooked at the previous act when it was introduced was Section 6 of General Clauses Act was not being specifically referred, right? It was not part of the statute. However, judicial authorities used to take a view saying that General Clauses Act is a mother thing which should apply for any transition. However, in the current 2025 Act through Section 536, the reference of General Clause Act has been clearly introduced, where if there is any mode for any planning or anything of that sort, I'm sure General Clause Act can be sheltered and the interpretation will be taken according to that aspect. Also, previously, when 1961 was enacted, I think the transition in terms of how do we file return of income. Say in our particular case from 1st April 2026, 2025 Act is enabled. However, previously, there is no clear demarcation in terms of how does the form gets transitioned. However, in this particular transition clause, it has been clearly laid out that in the new act, you still file the income tax return of the old act, giving reference to the repealed act. So all the assessment, etc., will be covered in the repealed act and nothing will change. So essentially, till 31st March 2025, whatever is the income will be governed by 1961 Act, including the assessments. So moving on, let's break 536 into sub sections, right? Subsection 1 clearly calls about the repealing of 1961 Act. Section 2 calls about what should be saved. Is repeal equivalent to resetting? The answer is no. There are few provisions which can be saved and which can be carried forwarded. There are few clauses which needs attention, where clear demarcation of how things are being moved out has been clearly laid out. So let's break into subsection 2, where clause C, D, and E particularly talks about any procedure, any penalty related items, notice, assessments, reassessments, everything will get transitioned into the new act. Whatever is there as part of the old act will continue as is until the completion. Similarly, with respect to reporting, payments, anything with respect to circulars, anything on the with respect to say I would have had APA proceedings, MAP proceedings, I would have signed up an APA, etc. All of them have been covered. I think there are few curious things which we'll have to look through in detail, where as part of the penalty proceedings, where on the transitionary clause, the word may has been introduced, where it might lead to an ambiguity saying that is it a directional change, or is it a mandatory thing for us assing officer or the income tax department to really look through the new act or take from the old act is something which time will test and let us know how this provisions will be used. However, with the General Clause Act should not really be a big concern, but however, this is something which is important for us to really look at it. Similarly, with respect to APA proceedings, right? We understood that APA, whatever is signed, will get transitioned. But however, if there is some talks which are ongoing, which are not yet finalized with the authorities, what about it? There is no specific section which really deals about it. But however, with the general clauses and other interpretations, it can be safely assumed that proceedings will continue. And once the closure will happen, whether it happens before 31st March or after 1st April, depending on that, I'm sure the APA proceedings will have an outcome, whether that will be part of the new act or the old act. So moving on, subsection F deals with the option or the election, right? So there are a lot of taxation regimes which people would have adopted. We could have adopted for safe harbor rules. All these things automatically get carried forward. There is clear certainty in terms of whatever was opted previously will stay away, will stay put. Nothing will change. There is no need for any re-election which has to be done. So it's assumed that whatever was done previously is assumed to be done in the new act as well, apart from few particular sections where some attention is required. Otherwise, the transition is very smooth. Moving on to interest on refunds or any defaults, right? One important aspect would be to check I could I could have defaulted something under 1961 Act. However, that might be a continuing offense in 2025 Act. One clarity which is not there as of today is there might be a need for us to file multiple forms, one for 1961 and one for 2025. I think these certain teething issues will 100% be taken up on an ongoing basis. Whenever there are few things, there's a lot of things for us to learn as well, right? Because there are so many things which could really go wrong. I think this is another important aspect for us to keep in mind in terms of any ongoing refund or related matters or ongoing cases where the interest meter is on. How do we settle with it? Whether all of them will be clubbed in the old one, new one, that's the clarity which we need. There are few other clarifications which have been added on the clawback and recovery of dues as well. Where since I was talking about the made discretion for the penalty proceeding, right? The similar discretion on may word has been provided in this particular recovery of due as well, which might be very critical where the recovery of dues will be done under old act or a new act. Time is something which will have to essentially test it. Or particularly the department might take a view saying that they would like to do it under the new act, which is much more cleaner or easier from them to implement. That's something which time will tell us an answer. Also, moving forward, also there are specific agreements, approvals, or registrations, approvals which would have got. All of them will essentially continue, and there is nothing which we'll have to reapply. Say, for example, any approval of lower withholding, any trust registration, or any APAs or NAPAs which have been signed previously. Also on the deadlines for appeals, applications, reference, anything, right? All those things will be read as though whatever is applicable for the old law will apply. There is no extension which is really granted for old law to new law. Similarly, it applies for MAT and other provisions as well, where one important aspect for us to develop upon would be on the TDS and TCS credit, unadjusted refund amounts, etc. There is no clear demarcation or indication which is being provided in that, which I'm sure with the General Clauses Act being into the picture, that should automatically come through. But this is something which might have a practical difficulty in terms of taking it forward. Moving on with respect to carry forward and set off of losses, I think one one beautiful thing what they've done is they've clearly demarcated the specific sections in the old act, which is for the each particular head and how the transition will work. But there is one strict interpretation where one could really align that the moment of transition from capital loss has not been bifurcated between short term and long term. Can one take a view saying that there is a one time possibility for any person to plan in such a way that long term capital loss can be set off against the short term capital gains in 2026? The answer is yes. On the strict reading of the law, that's how one can interpret. But however, this is something which can be like a one-time exercise for FY 26-27. But I'm sure this should have been plugged as part of the budget. There were few amendments which were done in 536 as part of the budget as well. But this is something which was overlooked, which is something very important for all of us to analyze and see if there is something for us to plan around this. Moving on with respect to losses and depreciation for amalgamation, successor, all those things have been clearly laid out, and all of them have been ensured that there will be a smooth transition from the old act to the new act. Similarly, with respect to the deemed capital gains, right, there could be certain exemptions which would have claimed under 1961 Act, where in 2026 Act we breached the conditions. That also has been plugged in appropriately to ensure that whatever is lost previously, that similar effect will be given as part of the new Act as well. I think once we start transitioning from old Act to new Act, it becomes very critical for the management or for the clients to and essentially list down all the activities in terms of what are all the compliances or what are all the registrations as well as any other exemptions which have been taken, say in the past 8 years. Make a chart and ensure that all of them have been ticked as part of 2026 Act. It's more like doing a due diligence on anything which is pending or any restructurings which have been taken. That that gives a clear indication for us to say that where are we moving forward, where it becomes a very important starting point for us to transition from the old to new act. Similarly, there have been other transitionary provisions with respect to allowances, deductions under so many sections. For example, 35 ABA, ABB, 35D, 35 DA. Similar, all of them can be added and deemed, it will be deemed as it will be part of the current act. So the transition has been clearly laid out, even in terms of our provision for bad and doubtful debt and the other related provisions. So I think with this transitionary provisions, one important aspect for all of us to take as a homework, right, is to ensure that we make a list of items where we have taken either exemptions, registrations, or anything, right? And ensuring that all of them are clearly demarcated in terms of the how do the transitionary provisions work, as well as read it with the appropriate rules and ensure that as part of the first return filing or whatever is the next return cycle or any submission cycle, right? Ensuring that all of them have been ticked in the box to ensure that nothing has been missed out so that initial teething issues, etc., can be avoided and be compliant from 2025 Act onwards. Maybe with this, I think we can conclude the transitionary provisions, and maybe I would like to pass on the mic to Ankit for taking on few aspects on the draft income tax rules in terms of few things which have changed, etc. Over to you.
Thanks, Chetan. So moving into draft income tax rules, again, uh, even in the budget, Madam Sitaraman announced that sooner or later, before the end of this financial year, the draft income tax rules and the forms would be rolled out. And in continuation of that, the draft income tax rules forms was announced last week, right? Now, what has actually the government done in this draft income tax rules and the income tax forms, right? I mean, the essence is same. What was there in old income tax rule 1962 continues to be there in draft income tax rules 2026. The only thing that has got changed is again simplification of language. The redundancies has been removed. They have brought in many things in form of a formula or table. in the similar line what they have done with the Income Tax Act, right? And with respect to the forms would have been simplified to that extent, right? It has been standardized. There has been automation of the forms. We may see when it is really live. There would be a lot of pre-fill options which would actually fetch the data from various other depositories that the income tax has got it. So in essence, if you see the number of rules has been reduced from 511 to 333, and the number of forms, a drastic number change in the forms from 399 to 190. Having said that, there are few important things that we have come across when we have read the draft rules, right? I mean, the first important change is with respect to filing of TCS return, which has been now aligned with the TDS return itself, so that the due date of TCS and TDS return is one and the same, which is the end of the next month ending particular quarter, right? Second important change that we noticed was the detailing of the transfer pricing audit report, right? It's no longer a simple transfer pricing audit report. Lot of details with respect to your how arm's length margin has been derived, what is the operating profit, what is the operating cost, which method have you used, why you have not used other methods, right? And even whether a CA has to certify whether the transfer pricing study documentation has been in place before one files the tax or TP audit report. So that is an important change that has been brought at least I mean, for a client which has an international face from that perspective, right? Talking about few other important changes, one change is with respect to a foreign tax credit. If you have a foreign income and you want to claim that foreign tax credit, earlier, I mean, simply you would have filed a foreign tax credit form and claim that credit in offset against the tax that you have to pay in India, right? But now an additional CA has to, an additional responsibility has come to a chartered accountant who has to actually certify that whether that foreign tax credit is an eligible credit and whether he has verified all the documents before you actually, an SSA, before actually they file the return of income and claim this foreign tax credit. Now, the two important changes from a non-resident perspective is Form 41, right, which is nothing but form equivalent to Form 10F under the old 1961 Act. When any non-resident wants to claim a treaty benefit, they have to file Form 10F. In case if TRC would not, I mean TRC, by TRC I mean tax residency certificate, would not have all the relevant details prescribed under the IT Act. However, that has been gone away. Now, even if TRC has got the relevant details like name, address, phone number, email address, etc., still there is a requirement for a non-resident to file Form 41. So that is a new addition that is made in income tax rule. And a new interesting addition that has been made in Form 41 is providing the communication address in India, right? I mean, if a non-resident is entitled to claim treaty benefit, he has to file Form 10F. In that equivalent to Form 10F, Form 41, in that he or she also has to mention what is his communication address in India. Now, we really need to understand and deepen how this would impact from a permanent establishment perspective if they quote the communication address in India for a non-resident perspective. The last important rules, changing the rules that we have come across was crypto reporting framework, which was long due waited, right, from a crypto fraternity, right? I mean, after a lot of discussion with crypto players and the advisors, I mean, formally now this form reporting form has been notified by the department under the Income Tax Rule 2026. Few other small changes, more in terms of giving an effect to inflation. And if you see all this children education allowance, hostel allowance, 100 rupees, 300 rupees was the time when it was introduced in 1961, and over a period of time, no further changes was made to such amounts for claiming exemptions. However, good fortune in 2026, the rules have now got amended, wherein the 100 or 300 number has increased to 3,000 per month or 9,000 per month from a for a salaried employed perspective, right? And similarly, there are a few other changes in terms of interest-free or concessional loan exemption limit, the food and non-alcoholic beverages exemption limit, or the gift voucher exemption limit from that perspective. The one important change, again, which Chetan also highlighted, is that the definition of books of accounts was changed to introduce the cloud-based storage of data, right? That particular change has also been brought into the rules, where in case if anyone keeps their books of accounts in a cloud form, from that perspective, then all those cloud has to be, or the server to store that cloud has to be necessarily be in India. Right. So this is again in line with the data protection from a data protection perspective. So with that, basically, these were the important uh, things that was brought out in the income tax rules. While over the next course of session, we would be discussing in detail when we go into each chapters how and what are the changes that has been brought in the Income Tax Act as well as income tax rule. Before we conclude, important line that I would like to mention when we talk about 2025 Act is that 1961 Act was about building a strong foundation, whereas 2025 Act is about restructuring or rebuilding the superstructure for mature digital and global integrated economy. Very important for people like us. Once in a lifetime, we see the shift from the old app to new app. Lucky to be in that position. At least we'll be happy to tell our fellow co-workers, telling that something we have seen, the new income tax provision, which from day one, neither they or nor us. Now we are all on the same page, learning new things from the scratch.
Maybe on a lighter note, maybe post 10 years, we can tell our colleagues to say that we were part of the epic shift from 1961 to 2025 Act, and we have seen a paradigm shift. That's something for all the professionals. It's very, it's a matter of pride to be part of this journey, right? And all of us will look for it, and I'm sure all of us will learn more about it. And there's a lot to add to this and take it forward.
Got it. Cool. So we have just a few more minutes to wrap up this session. We have few queries. What was that? Move it and file. Yeah. So,
like this question from Mohit Kumar, where the query is essentially if there is assessment for FY 2025 and notice is received in 2026, will it be gone by 1961 or 2025? I think the answer is clear that it will be gone by the previous Act 1961 because the relevant financial year did not have the Act enacted from 1st April 2026, or the income never accrued as part of the 2025 Act. So the answer is clear that it will be gone by the old Act. The returns for 2025, will it be under 1961 or 2025? It will be under 1961. Also, with respect to, there is another question from Sangeet, where from 1st April onwards, how will the Form 15 CAC be issued by CA? What will be the necessary documents for foreign remittances? I think broadly the form number will undergo change, but the attachments, etc., will kind of be the same. That clearly has been demonstrated as part of the rules. I'm sure that there will be a lot of forms and additional documents which will be given as well. This will be a journey which all of us will have to be part of. Maybe the form will not be called as 15 CACB, but something else. But that for sure will come through.
we have one more question from Mohit. Mohit, no change with respect to those exemption limits when we talk about new tax regime, right? I mean, the changes would really impact the deductions that one would have claimed in the tax regime. We'll wait for a couple of minutes in case if anyone has query, please feel free to post your queries in the chat box and we'll be happy to take it up. Please wait for a couple of minutes. Thanks, Pankaj.
Thanks, Pankaj. Thank you, Ankit. Thank you, Mohit.
Sure. So maybe we'll just close this session now. Good session. Lovely for all of you to join this session and look forward for you joining the next session as well. I mean, next Thursday we have got session and the import. I mean, please do join. It's an interesting session on the capital gains as well as the taxation around M&A aspect. The timing is again, we'll have a session starting from 5 p.m. Onwards next Thursday. Look forward to you all in that session. Thank you.
Thank you, everyone.
Thank you.
Have a
Thanks.
nice
Bye.
day. Bye.